Hello, and welcome to the next in our series, Insights into IFRS 17, the new insurance accounting standard. I'm Gail Tucker, PwC's Global Accounting Technical Lead for Insurance. I'm a member of the ISB's Transition Resource Group, and for many years I sat on IFRAG's Insurance Accounting Working Group. I'm delighted to be joined today by Jitka Uhlirova. Jitka's a director in our Canadian Capital Markets and Accounting Advisory practice. Welcome, Jitka.
Happy to be here, Gail.
So what we want to do today is to look at the general measurement model under IFRS 17 and that first building block, the expected future cash flows. I should say now, the one thing we're not going to do is to look at the risk adjustment and the discount rate. Both of those topics will be topics on their own and the subject of future videos. So let's start off with that first building block, Jitka, and the cash flows. Which cash flows are we talking about?
Well, the cash flows we expect to be included in the future expected cash flows will include premiums, claims, and benefits such as incurred but not reported claims, incurred but not settled claims, but also claims that we expect to be settled in the future. We will be also including discretionary payments and payments that may vary with underlying items. This will also include payments to current and future policyholders. So companies like mutuals might be seeing payments that would include amounts not payable to current policyholders. We will be also including payments from embedded derivatives, such as options and guarantees, and service and non-investment components that will not be bifurcated from insurance contracts. So this is quite a long list, so let's have a look at what is new. Transaction-based taxes, including premium taxes and levies, which the insurer pays on behalf of policyholder, will be included in cash flows. However, income tax payments and receipts that the entity had not paid or received in a fiduciary capacity will be excluded. Those are in scope of the requirements of IAS 12. And therefore not part of the measurement of insurance contracts. However, in some countries, insurers make charges to current and existing policyholders in respect of income tax borne on their behalf. While these tax payments will be in scope of IAS 12, the charges to be received will be in the future cash flows.
Thanks, Jitka. And I know that one of the things I often get asked about is the overheads. So IFRS 17 is clear that within those expected cash flows, we include overheads, both fixed and variable, that are directly attributable fulfilling the insurance contracts. So the standard talks about things like rent, depreciation, IT costs. Now, interestingly, the standard also talks about costs that aren't included, such as, and they use the example of product development and training costs. So clearly there's going to be a judgment and insurers are going to have to look at their cost base and decide which are directly attributable. Those overheads get allocated to the insurance contracts on a rational and systematic basis. And I think the important thing is that basis should be consistent for similar types of costs. So clearly the cost area is something that companies are going to have to look at quite carefully. So when we think about costs, the other costs clearly that insurance companies often have are acquisition costs. So today, many of them are deferring acquisition costs. What happens to those in the building block model?
Well, the acquisition costs will be included implicitly in the contractual service margin and allocated to revenue as revenue is earned and service is delivered. So effectively, the unearned profit will be smaller to the extent acquisition costs have been incurred. So what qualifies as acquisition costs? Well, those will be costs like selling, underwriting, and starting of insurance contracts, and that are directly attributable to portfolio of contracts. So there is no requirement for the acquisition costs to be directly attributed to individual contracts or group of contracts, as long as they are attributed to the portfolio of insurance contracts. However, as you mentioned earlier for overheads, insurers have to be able to allocate the cash flows that are not directly attributable on a reasonable and consistent basis. And it is not always clear which acquisition costs are directly attributable, so insurers will need to think about it and assess their costs for this criterion.
Yeah, and that's going to be another key area of judgment in doing this. And I think it's interesting because when we think about acquisition costs, I know in some parts of the world today, insurers only treat direct commission as acquisition costs. So adding overheads into that will be something that will be very different. So insurers are going to have to look at their cost allocation model. So we've talked about the actual type of cash flows that are going to that measurement model. Of course, what IFRS 17 also tells us is that it's only cash flows up to the contract boundary. And that contract boundary might not be the same boundary that we use in accounting today. So what are some of the judgments and issues insurers need to think about there?
Okay, here are the key points. IFRS 17 requires that cash flows are included in the measurement if they arise from substantive rights and obligations, such that the insurer can compel the policyholder to pay premiums, or when the insurer has substantive obligation to provide service. This sounds straightforward, but the standard explains that insurer does not have the substantive obligation if it can reassess and reprice the risk of individual policyholder or reassess and reprice the portfolio, as long as this repricing does not take into account risks after repricing date. So these requirements will affect contracts that involve repricing, such as health insurance contracts, where the boundary might be different than the way they are accounted for today. For example, let's think about a life policy that guarantees coverage for 10 years, and the insurer can't cancel the policy. However, the insurer can change or increase the premium on an annual basis, but the rate will be set for the entire block of policies, not individually. The policyholders, on the other hand, have the right to cancel the policy annually. So the question is whether this contract has a contract boundary of 1 year or 10 years. Because the insurer can reprice the portfolio and therefore can't compel the policyholder to pay premiums beyond 1 year, this portfolio of contracts is likely to have a contract boundary of 1 year.
And I think it's quite important to look at the details here as well. One of the things that became clear in the Transition Resource Group discussion we had earlier this year was that when you're thinking about which risks are being reassessed and repriced, we actually have to think about it's the policyholder risks. And by that I mean it's the risks that are transferred from the policyholder to the insurer, like mortality. It's not other risks that the contract might bring to the insurer, such as lapse risks. But clearly it's going to be a huge amount of judgment, and what I would encourage insurers to do is to really look at the terms of the contract to be very clear whether they have the practical ability to reprice the contract for the risks, as that will determine the contract boundary.
Gail, one of the interesting issues that the TRG discussed was a non-refundable commission on some contracts that the insurer might pay with respect to an annual policy. However, it is expected that they will obtain renewals, and they are pricing this commission with expectation of these renewals. So how would we treat this commission, this non-refundable commission?
Yeah, that's a really good question, Jitka, and it brings together the two aspects, contract boundary and the cash flow. So this was a question that came to the TRG, and unfortunately all the TRG members did agree that as the standard is written, because there's no refundable element of this commission, the whole of that cost gets allocated to that first annual, let's say it's an annual policy. And in some extreme scenarios, if you think about it, that could make that contract onerous if it has been priced such that the commission is more than the premium. We don't like that as an answer because economically that's not what insurers think are happening, but unfortunately that is what the standard says. However, in the discussion at the TRG, it was clear that if there was an element of clawback or refunding of that commission if the policy didn't renew, then that would be a different facts and circumstances. In that scenario, some of that commission could be allocated to the subsequent contracts. I think it'll be very interesting to see if some of the contractual terms of these commission arrangements and broker arrangements do change when IFRS 17 comes in, because clearly economically they have value because of those subsequent renewals. So that's all we have time for today. So we've covered the cash flows and the contract boundaries. I do hope you found this video useful and you'll join us for future videos. Thank you.